TheoTrade. This is Don Kaufman. October 7th, 2022. 25 minutes ago to the cash close. Markets are an absolute dumpster fire into this close. Right now, down just about 3.3%. Nasdaq off by over 4%. We're going to dig fairly deep into some of the price action, obviously, on the screen right now, because this is just, well, shots fired. Our new lows on deck for this marketplace. Let's get to work on this weekend update. As I was saying, just a dumpster fire of a marketplace right now. So the S&Ps in just the last 30 minutes of trade have effectively been straight down. And that is largely predicated on some trade that had not broken until literally, well, the last 30 minutes. And that's specific to the XLE. This is the energy sector. This is also one of the preeminent sectors that I discussed the possibility of a significant and precipitous break as this week actually kind of went on. And I'm telling you, we are at lows right now, okay, specifically in the XLE on an intraday basis. If you hadn't looked at the XLE, though, on a daily chart, look at the wild bid into this. And what's crazy about the XLE, this has been the sustaining bid to the S&Ps throughout the course of the day. You know, this is one of the trading sessions where, well, first of all, I love recording into the cash close here, especially on a Friday. The last couple of Fridays, it's been intense. But there's nothing like, 20 some odd minutes to go into the close. You have a sector that has been unequivocally, it's like the sector that's been holding the markets together. It has been the glue throughout the course of this week, and it's coming unhinged right now. There is huge trade action right towards kind of the bottom of the barrel here in the XLE. And if it continues to break lower, it is going to smash the S&Ps. Now, before we get too deep into some of today's price action, I think it's critical to bring up and, in fact, to respect the fact that, well, if you look at the SPX, if we were to close right here, right now, the S&Ps are actually going to close the week slightly higher. I know it doesn't feel like it because ultimately last Friday, we closed at the absolute unequivocal lows of the marketplace. And we're right on deck again to do it again. I mean, for lows of the marketplace, well, you can see the lows are what? 35.84. If you're taking a look right now at the SPX for 36.25, you think to yourself, oh, there's no way. I mean, come on, another 40, 50 point drop inside of the S&Ps? Probably not, but anything is plausible in a marketplace. It feels like an absolute bottomless pit at this point. But as I was saying, again, we've actually got, a marketplace that's technically higher on the week. This has just been some fairly wild trade. And I'm going to kind of systematically break that down for you. And again, if you're missing this on the screen, the XLE now on a little bit of a bounce. Probably one of the most wild things, though, going on as well is oil's up $4 with the energy sector starting to actually break lower. All right, let's get to work here on the weekend update. Cruise over to my scratch pad here. As I said, shots fired. Our new lows on deck. First and foremost, jobs number came out this morning. That, okay, is the jobs number. Now, for those of you that maybe missed the jobs number, what was it? It actually beat some of the expectations. It's, when it comes into the numbers, it was 263,000 jobs. I think they're expecting about 255,000, depending upon which economist you ask. But the real key factor to the jobs number that sparked wild sell-side activity was the percentage of unemployment. It was actually estimated to come in at 3.7%, came in at 3.5%. The market got crushed on that one. So again, think about this marketplace that you're living in now. Good jobs gone bad. So decent numbers, okay, cause the marketplace to sell off dramatically. Why? Because it allows the Fed, okay, to keep the foot on the accelerator in terms of interest rate, okay, going up. And the next Fed meeting will be prior to, well, the next jobs report. So one of the first things that I would like to introduce you to is Fed probabilities, because they are absolutely flying here. If you hadn't looked at this, this is the CME Fed Watch tool. And if I go ahead and refresh, okay, I'll explain just, albeit briefly here, but this is one of the primary reasons that markets are getting tagged extraordinarily hard today. If you take a look at the current rate, this is Fed Fund Futures, that basically means, okay, about 3%. So what are we looking at over here? Right here, there's an 18% probability of jumping rates a half a basis point. Right here, the almost 82% probability is that actually of jumping rates 75 basis points. This shifted dramatically on that jobs number. And that's one of the reasons the market's getting absolutely crushed in today's trading session. It just has to do with Fed Fund Futures and the implication that the Fed is going to remain heavily, okay, if you will, on the bid, and that is moving rates considerably higher in the next FOMC meeting. If you're unfamiliar with when the next FOMC meeting happens to be, you're looking at about November 2nd for the next Fed report, which again is before the next jobs number. Now there's other data that's going to come out, but this was the big one. It was absolutely huge. There'll be CPI and so forth coming out, but this was a fairly critical number. Again, the Fed probabilities for a 75 basis point hike have flown through the roof. So again, it's what I call good jobs gone bad. That one, it's fairly simplistic though. Okay, and looking at Fed probabilities, fairly simplistic. Now we're actually going to start to get into the meat of what I would call cause for concern. That's why I call our new lows on deck. You're going to question new lows. Yeah, the funny thing is here, I'm not just referencing into the S&Ps. New lows on deck. What I really want to start with is bonds. Bonds are what I would term on the edge of the abyss. All right, so one of the things that in last weekend's update I was talking about is you can kind of almost extract bonds a little bit from the equation. But here we are once again, okay? Bonds are very close to breaking into new lows. And that is what I would actually that's really what I would reference as the kind of the dumpster fire for this marketplace. If these bonds start to crack into new lows, we could be in a very similar situation rather rapidly to what we saw, okay, in the Bank of England. That is, a rapid decrease inside of the bond market actually sparks all kinds of wild derivative trades just to get blown apart. I could spend ample time on that, but for the most part, what am I really referencing is the bond have some heavy sell side activity. Interest rates are going to explode. Okay. In doing so, again, there are incredible implications of this. One of the implications, of course, could be is almost an immediate pivot or change in rhetoric of some of the Fed. The marketplace could actually drive the Fed to do so. And that's something that I've talked about extensively on some of these nightly videos, that again, heavy sell side activity, specifically inside of the bond market, all right, can actually break the back of the Fed. And it's something that, you know what, I didn't expect it to come this quickly, but we're right down there right now. And again, when I talk about new lows on deck, the implications to me are not so much to the S&Ps. The S&Ps will absolutely follow suit. The implications, okay, at this point in time, okay, is a precipitous break lower in the bonds. You break the bonds lower, you'll snap the back of the S&Ps. We're going to be off to the races. Volatility will absolutely erupt, and we're right there. Now, of course, you're going to want to look at the technicals. There's no technicals. Like if you're a trend follower here, look, the trend is effectively straight down. Okay, this just comes down to the fact that is the market going to push the Fed to the brink? And at this point, again, I'm just going to give you an opinion piece over here. I believe so. I think we're actually going to see some new lows in the bond. We could even see, a 120, 121 print on the bonds. Now, I'll remind each and every one of you, bond markets are closed. Bond markets are closed on Monday. Okay, it is a banking holiday on Monday, but equity markets are going to be open. So we're going to get a little bit of a breather. Okay, in the bond market, it's going to be a 4-day trading week for the bond market. Nevertheless, as early as, again, kind of mid next week, you could see the bonds cresting new lows, and that, people, could actually spell serious trouble for the S&Ps. I'm also going to be watching financials very carefully, which I'll discuss here momentarily. Again, bonds are the edge of abyss, and The biggest implications come from this marketplace. For those of you that are not necessarily like complete and utter bond geeks, maybe look over like the TLT. The TLT literally is at its effective lows. In fact, you've got to go back years, years. That's a 5-year chart, okay, all the way into a 10-year, and you're seeing effective lows right here, right now on a 10-year, okay. I mean, for the most part, you look at this and you recognize like bonds have crashed. Bonds have crashed, and it's probably the single most important thing, okay, in terms of finance in global finance, and they're completely and utterly getting crushed at this point. Okay, you need to have cause for concern when equity markets are going to and very likely to follow suit. Onward and upward. Sorry to be such a downer on that particular front, but again, it does look like this bond market is going to take everybody and everything right to the edge of what I term the abyss. Okay, we're going to spin a little bit off some of the bond talk. There is one thing that has also grabbed my attention considerably in some recent trade, and that is low beta equaling high risk. One of the things that really has grabbed my attention, and I've talked about this extensively, it's been a few months though since I've really laid into it heavily. Take a look at the XLU. This is the utility sector. Okay, utility sector is in an outright horrendous crash. Even a bid back to the marketplace was not helping it, okay, so much earlier this week. But again, the XLU, why the cause for concern over here? You do realize the XLU is actually paying about a 2% dividend. Now it's about a 3% dividend, but it's a 0.24 beta. What that, okay, implies, and the reason that I am bringing this up is low beta, okay, means for the most part, if the S&Ps are moving 1%, okay, this thing, the XLU or this stock, whatever we could look at over at Procter & Gamble or Verizon, they're supposed to move, okay, about what? About a quarter of what the S&Ps would be moving. So for every 1% move in the S&P 500, you should get about a quarter point move, for instance, in the XLU. Is that relevant at this point in time? The answer is, oh, hell no. This is insane, the move that you're seeing over here. If you look at it a year-to-date percentage, this was up 10% a few weeks ago. It's now down 10%. It's 20%. Absolute outright crash inside of the marketplace. It's not just in the XLU. It's anything, okay, people, that was a heavy dividend payer. Here's actually Verizon, now down 30% a year-to-date basis. Forget about the fundamentals, okay? This is and everything to do with low beta stocks. Also, heavy dividend payers, it doesn't make a difference at this point. Okay, it's every man, woman, and child for themselves. Let's also take a quick glance over at Procter & Gamble. Now, some of the cause for concern over here, Procter & Gamble, also a 0.38 beta, getting absolutely crushed. There's a reason, by the way, that I'm bringing up, okay, Procter & Gamble, Verizon, XLU, they're actually dramatically different sectors. So across the sectors, low beta is actually getting hit. The implications to me of such, for instance, like XLU taking just a dramatic hit, has to do with the unwinding of very significant size portfolios. These are supposed to be like, when you think of like blue chip stocks, they're going to be boring. That's why I'm selecting low beta. They're starting to decimate 401ks. And if you start to decimate a 401k, you're going to get more redemptions. You start getting more redemptions, that's when you need to really start looking back at something like Apple. Why? What do you think is the most widely held product? I mean, there's a reason that Apple is the largest market cap out there, which actually brings up, okay, the MegaMarket Cap at lows, which again, we're talking about a new leg of extreme volatility forthcoming. Okay, and in a new leg of extreme volatility forthcoming, what do you think is going to be leading the extreme volatility? It's interesting because like the XLU and all of these like low beta stocks, nobody's really paying attention to. And you should. You should, because the low beta stocks are actually seeing extraordinary amounts of risk. But the implications to me aren't so much about low beta stocks. All of a sudden, it's going to be, okay, the marquee stocks. It's going to be the mega market cap. Anything, okay, anything that has actually been sustained until this point is coming off. And I talked about that exclusively and extensively in last weekend's update. And every single product that we discussed has come off dramatically, other than the XLE, which is now taking a little bit of a hit here into this cash close. But I want to bring back up Apple, because Apple is not yet, okay, at year lows. But if you look around at other, what I would term mega market capitalization, what is it? Let's start with something like Nvidia. Nvidia at lows. What else you got? Meta, obviously. Okay, do I even need to bring it up? Meta at lows. Okay, next, Microsoft. Let's take a quick glance at Microsoft. These are your mega market caps. Microsoft, hop, skip, and a jump off its absolute lows. Now you got to have cause for concern because Google, where is Google? Hop, skip, and a jump off of its lows. All right, Tesla. Oh, this is worth taking a look at. Tesla's getting absolutely decimated. That was one of the key constituents that I actually mentioned taking the biggest hit. Tesla, hop, skip, and a jump off of the yearly lows. In fact, this one's worth bringing up on a 3-year because it's awe-inspiring. We start to lose maybe like the 200 level, okay? It's over. I mean, this is a product that can actually drive the S&Ps into the ground. Look at what's going on in this marketplace. Okay, that all of a sudden you had this low beta stocks that were holding up extraordinarily well. Guess what? Now they're going to hit them all. They're going to hit them all, but it's the mega market caps that are really going to have the pressure on the marketplace. Then let's switch sectors because you think in mega market cap, it's just big tech, Don. That's all you're mentioning is big tech. Yeah, until you start to look at something like, JP Morgan, which what? I mean, we're into multiple year lows. Okay, we start to break through here. We're going to be into multiple year lows. Okay, interesting irony here. JP Morgan also pretty much at lows, earnings coming. When? Ooh, next Friday. Citigroup. What are we looking at in terms of Citigroup? Pretty much hop, skip, and jump off its lows. And then last but not least, for instance, Bank of America. Again, all the banking stocks coming out with earnings in the next couple of days. So one of the implications that you really have to start to think about is, let's switch gears. You have bonds that are once again starting to pressure, which, hey, far be it for me to say, is that one's actually a little surprising. I didn't think bonds were going to come off that quick again, but they have. But the real cause for concern right now is, again, low beta being high risk, causing the start, if you will, of an unwind of a lot of retail portfolios. 401ks, they're going to start getting tagged. If you start doing redemptions in those 401ks, it's the mega market caps that are really going to take the biggest hit. And you're starting to actually see that. What I'm talking about, for those of you that are unfamiliar with the terminology, outflows, major funds. You start to think about what's in a Vanguard 500 fund, okay? Apple, Microsoft, Tesla, Nvidia, Google, okay, JP Morgan, Citigroup, Bank of America, they're all part of the S&P 500. But again, that low beta kind of tips us off that there is some significant outflows over there and that the next leg of extreme volatility is forthcoming. Speaking of volatility, if you're looking at VIX today and you're thinking, but the VIX is not accelerating, of course not. The VIX is not accelerating to the upside, not yet anyway. Why? Because we haven't actually cracked through the lows. Again, every time you see a scary movie, right? The first time you see it, you go, oh my. The second time you see it, you go, oh yeah. The third time you see it, lady, don't go in there. Remember, the VIX, okay, it becomes progressively smarter. So at this point, it's already seen this, horror film a couple of times over here. It's going to need something extraordinary, something scarier than it has seen to actually break back to the upside. But you got to be careful at this point because it could be the bonds that break. And there was actually a reason that I kind of wrapping everything together over here, because if the bonds break, I'm going to tell you right now, from the seat that I sit in, the bonds breaking is the scariest thing I've actually seen, okay, since the financial crisis. And I've actually had to bring up the financial crisis a number of times, literally in the last, 2 weeks, to give you a feel of how significant some of the volatility that we're presently seeing. Unequivocally, this is the highest risk situation we have been in since the financial crisis. Okay, does it mean a financial? This is not about the financials right now. Okay, it's about everything. But the bond market, okay, selling off, that's, again, the implications of this are possibly worse than the financial crisis. The bonds, selling off, the implications are global at that point. So new market, the mega market caps are all basically sitting at lows. A new leg of extreme volatility forthcoming? Absolutely. And again, don't necessarily look for the VIX to do anything shocking until those bonds broke into new lows and the S&Ps broke into new lows. Meanwhile, if you do take a look at the volatility futures, okay, one man's contango is another one's backwardation. What I'm referencing in this case is stop looking at the 12-day volatility futures. They're over and they're done with. Start looking at 40-day volatility futures here. 40-day vol futures over 75-day vol futures, we are in a wicked little backwardation here. So the backwardation, though, And again, I'll kind of zoom this one in a little bit. This backwardation is 30.95 against 30.18 and 30.87. What I'm basically referencing is these 40 days are above basically everything. Okay, we're in a full-fledged backwardation. So, what does that mean? It's on, people, it's on. Obviously, one of the last things I wanted to talk about on this particular front is that earnings are on deck. Banks are up first. You get your IBMs out there, but lo and behold, okay, hang on, because we've already heard some warnings, specifically today, warning out of AMD. So these banks on deck here, okay, a lot is going to be relinquished in some of the bank earnings. All right, let's start to break down a little bit more of the market as a whole. So if you take a look at the S&Ps, one of the most effective things I could do in the S&Ps, of course, look at the SPX Expected Move, which we will in just a moment. Before we get there, though, I want you to see exactly where we are. Let's look at a 30-day 1 hour, okay? And I'm actually going to zoom in. And I'm going to box this in for a second. Freeze the screen, box it in. This is what I actually term a volatility box. And I've talked about this also extensively. In the volatility box, we literally popped through the upside earlier in the week. Here we are. We're almost to the lower edge of the volatility box. One thing you have to realize about this is we sat in this volatility box for quite a considerable period of time. So you've actually accumulated this tremendous amount of open interest in options, which is going to make it that much more entertainingly volatile. It's one of the reasons I was saying, like, hey, you talk about a new leg of extreme volatility, okay? We're right at the core of all the open interest that we've generated, all right? In the last, it's almost 2 weeks of trade, that we've just basically been sitting inside of this range. And I call that range a volatility box. All we're doing is pinging back and forth. And in doing so, again, we're accumulating more and more open interest in the options marketplace. The more open interest, the more gamma risk. The more gamma risk, the more explosive the move is going to be when we come out of the box. It's a very, very dangerous proposition, coupled with the fact that what? Oh, well, you do have dollar, which, again, I thought dollar would be taken out of the equation, but dollar is still threatening now highs. Bonds obviously are threatening lows. Volatility is poised to break out. Okay, every one of your mega market caps that matters right now is at or near lows. I mean, hey, there's just not a lot of positive things, Do you need positive affirmations in this marketplace? Because you're just not going to get them. Let's cruise over to the SPX, the mother of all products. By the way, in a day like today in the SPX, it's a Friday, and I am curious myself, how much size is the SPX actually trading? Okay, on this Friday afternoon, we are literally just seconds into the cash close, doing clear into 3 million contracts of a $3,600 product. Take a look at this. Okay, cruise from the SPX over to the spiders. All right, why? Because they're both the mother of all products. Just shy of 10 million contracts trading. You realize the entire marketplace is only probably going to do 45, maybe 47 million contracts. These two products alone are doing 13 million of that. It's just awe-inspiring. One of the things that you've got to understand about the SPX this week, well, again, we're going to close here in just seconds, right? And in this week, we are going to see markets slightly higher. So you can claim victory if you're a bull right now. We closed higher with the marketplace ready to close very close to its lows. Nevertheless, we smashed the upside of the expected move and came right back inside of it. What are we looking at for this next week of trade? Remember that the bond market is closed. Okay, the bond market is closed, okay, on Monday. All right, so it's a bank holiday on Monday. What are we looking at? About $125 to $126 move. It's only a hop, skip, and a jump higher again than the expected move we saw last week. So we're looking at about $125. I got to tell you, the fact that we've seen today over 125-point range does not make me feel warm and fuzzy about $125 expected move for next week. I'll tell you right now, there's no way I would actually be selling options with 7 days remaining and $125 expected move. With that, looks like markets are actually, coming into the close, kind of mellowing out to some extent. S&Ps are going to close down just shy of 3%. We got a little bit of a bid back under us, but have no fear. Some sell side activity may be right around the corner here into even and continuing after the close. With that, I want to thank each and every one of you joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.